Right. Well, good afternoon. Welcome to another in our series of webinars focused on energy private equity that we're putting on here at McGuire Woods. I'm excited to have a great panel with us today to discuss solar power investments and development, including Michael Gardner of Gardner Capital and Gardner Solar, as well as my partners Brian Kelly and Durham McCormick of McGuire Woods. I'll go ahead and give a brief intro of our panelists, and then we can dive right into the discussion. Michael Gardner is the CEO and president of Gardner Capital and Gardner Solar. Michael sets the strategic direction and oversees national operations of Gardner Capital and its portfolio companies, including affordable development, solar development, equity investments, and construction. Michael works directly with partners to structure financing for Gardner Solar's transactions, including organizing greenfield development and M&A. He currently is focused on investments in and development of utility-scale solar production facilities. And Gardner Capital provides both sponsor level and tax credit related equity for such transactions and focuses on utility scale facilities from 5 to 100 plus megawatts. Brian Kelly is the chair of McGuire Woods' energy industry team. He advises energy industry and financial clients on a wide range of transactions, including M&A, energy project and infrastructure development, project finance, and structured commodity and hedging transactions. Durham McCormick is the co-lead of our renewable energy team out of Houston. He focuses his practice on development, financing, M&A, and other transactions for renewable energy projects. He has a particular focus on tax equity financing for production tax credits and investment tax credits. And I'm Tom DeSplinter. I'm a partner in the private equity M&A group in Chicago. I've spent several years at in-house with BP's Oil Integrated Supply and Trading Group and with Blackstone Energy portfolio company Grid Alliance that was focused on power and transmission. So we'll go ahead and get started right into questions and discussion. A number of our individuals on our call here are listening in, either our funds beginning to potentially explore solar energy development or independent sponsors looking to develop or identify projects that could be presented to potential sponsors as development opportunities. So I'll kick the first question to Michael. Michael, can you kind of give us a little bit more background on Gardner Capital, Gardner Solar, what your background is, and how you got interested in the solar segment?
Yeah, thank you, and that was a great introduction. And thank you for having me. So I'll just give you a very, very brief overview. Is that I was actually a lawyer before. I practiced tax law for 3 years, but kind of always planned on kind of being in this space. We run a number of operating companies, but focus on equity raising and deployment. But we have a lot of development type activities, so a lot of that ends up being multifamily and then affordable housing. So we got brought in to really the solar space, via our investors. So we're very investor driven. So anyone, if they want to do something, we try to see if we can accommodate. And so that's really how we got into the solar space specifically. And that was, in 2013, 2014. And really we're trying to deploy as much capital as fast as possible. So looking to larger transactions where we could, again, deploy it with a smaller number of counterparties. Since then, I think our interest has become much more diverse in what we're interested in. So we've done, I think, everything from very, very small rooftop to utility scale, larger stuff. And we've kind of played every piece of the capital stack from tax equity with independent third-party investors of ours, tax equity in-house, our tax equity appetite, and obviously various levels of sponsor equity. So it's just, we've now been doing it for, plenty long where we kind of know what we're doing, but there's always, new stuff to learn, new types of deals that are getting done. Very geographic dependent, I think, on how we look at things. And where we want to be and the risk factors there. But yeah, that's how, that's kind of how we got in. And then, we have a general renewables focus, I think, across our platform. So we install solar pretty much everywhere, everything we do. Try to have an EV charging component as well. And that's nationally, whether it's in Arizona or North Carolina. So, yeah.
Okay. Great. You guys certainly have, done quite a few projects already. We'd love to, dig into that a little bit more. Brian, maybe, to start off and let your Michael's and then Durham's thoughts on this too, but, maybe give us a little bit of overview of what a project looks like, what a project timeline might be, from your perspective, and then maybe we can hear kind of how Michael approaches that.
Sure. Good afternoon, everyone. I want to give a quick overview from a developer's perspective and then a potential sponsor or debt equity provider perspective. So from a developer perspective, the first thing that any developer is going to look at is site control. Where is your facility going to be located? What rights do you have? What real property rights? What is the size of the facility you're going to be looking at? What goes hand in hand with site control is actually then grid access, or better known as interconnection access, and your interconnection application. Your interconnection applications and your timeline associated with your interconnection applications is really going to drive a significant portion of your entire development timeline. Depending upon where you're looking throughout the United States, you heard Michael talk about North Carolina, for instance. Developing a facility in North Carolina would be far different than developing a facility in Texas, for instance, or in Maryland or in New Jersey. Because of the rules associated with interconnection and your transmission. So depending upon where your site control is, and then also where your interconnection is, will drive timeline and also drive your overall size of your projects. In an area that is a vertically integrated area, an area, what I mean by that is an area that is where there's a strong utility base, where you're going to be more likely than not selling your power directly into a utility. The timelines associated with those interconnections are getting longer by the day, unfortunately, but your process and your size of your projects can be smaller. In areas that are subject to more of a broader coalition, better known as a regional transmission organization, and you'll hear terms like ERCOT or PJM, depending upon the ports of the country you're looking at, you'll have more likely than not larger facilities you'll be looking at because of the costs associated with your interconnection in those areas. What goes hand in hand with those two parts then is after you have site control and interconnection, you'll be looking then for your, at all times, looking for a offtake, and your offtake will go hand in hand with your financing. Your offtaker, depending upon where you are in a country, as I mentioned before, could be a utility. It could be you'll be signing up for an RFP process or a firm baseload PPA, better known as a busbar PPA. That would be a physical sale into the market rather. Or if you're in an area that is more liquid, such as the areas of PJM or ERCOT, you'll be selling that into the market on more of a physical or a financial basis. Your project timeline will be associated with that, as well as then your permits. Your permits in each one of those areas will be driven in conjunction with your site control. From there, you will then be looking at construction financing. And at that point, your developer perspective would go more to a sponsor perspective, because at that point, the developer will be looking for sponsor equity. And a sponsor is going to come in and diligence each one of the items we just talked about. Diligence your site control, diligence your interconnection, look at where you're going to sell your power, and looking at your permits, and provide either a equity participation, a purchase, or if it's going to be a number of projects, a equity into a holdco structure that can help fund those projects to development. That's a very broad, quick summary. But what I'd like to do is turn it over, if you don't mind, to Durham in terms of Durham, as we get to that piece, the tax equity component to that.
Yeah, tax equity is well, just first off, for those that aren't familiar with the industry and tax equity, it's kind of a term of art in our world. And for solar projects and quite a number of other renewable projects, there's federal tax incentives. And so what the tax equity is a way to help developers or owners of these projects help monetize those tax credits they would otherwise be getting into immediate capital. And so by going to large financial institutions or other strategic investors that want to or have the ability to monetize those tax credits, i.e. they have a large kind of known tax.
Darren, we cannot hear you very well. Sorry.
You cannot?
Yeah, maybe you can close the microphone. I think that's better, yeah.
I don't know where the microphone is, but
You're getting closer because it sounds better.
just put my face in you. Sorry about that. With getting tax equity, it's a way to finance those tax attributes, namely the tax credits. There's also depreciation, just like every business asset has as federal tax depreciation. But by bringing in a tax equity investor, a developer or sponsor that otherwise doesn't have that regular tax appetite or ability to monetize those, can get immediate cash from an investor. And in short, what it is, it's called equity. It walks like equity. It's intended for all tax purposes to be equity, but from the investor's perspective, the tax equity investor's perspective, it feels a lot more like debt, and that's what its purpose is as well. It's coming in to be a piece of that initial capital stack at COD. With solar, you get a piece of it at NTP. But when the project goes commercial in its simplest form, there's roughly a 35% capital stack that's being raised from tax equity, and then the sponsor is responsible for that remaining capital stack of 65 to 70%. Of course, these numbers are rough estimates. Every deal is a little bit different. And the primary way that tax equity is recouped, its investment, is through these tax benefits. So they're allocated in its simplest form in a flip model, 99% of all these tax attributes, which gives them immediate value. And then they're looking for a minimum return, and it's on an after-tax basis. So because they're getting all these large tax attributes, the cash flows that ultimately go to tax equity are relatively small. Each deal is different, but by way of example, the cash flows, the operating cash flows might be more like 15-20%. And of course, there's certain safeguards that allows kind of catch-ups to tax equity if the project's not performing as expected, and therefore they're able to get their minimum after-tax IRR. And then the business idea with tax equity is just that once those tax equity gets its rate of return is in the project for at least 5 years for solar, because there's just this minimum hold period. Otherwise, there's a recapture event. That would allow tax equity to be bought out, and they go down to really a 5% residual interest. It's kind of like a 5% tail. And so the buyout is relatively nominal, but there's a buyout. But the net sum of this is that when tax equity is looking at projects, they're diligencing them, very similar to what a lender would do. They're making sure that all of those development elements that Brian was mentioning about interconnect, site control, they'll look at the EPC contracts. They'll have management rights and other things like that. They're relatively passive, but they will have pre-negotiated consent rights for certain items that are material to the project, and in theory, put at risk their potential equity investment. But the idea is that they have a finite lifespan in the project. They're not there as an equity investor for the long term, like the sponsor is, or like the initial developer is, depending on how it's structured. But that's a quick summary of tax equity and why it's used in solar. And it's really a function of being able to raise cash for that capital stack at the onset, where otherwise those tax attributes would flow through to the owner and just not be utilized efficiently.
Thanks, Jeremy. That was great. And Brian, and that was a great overview. Michael, I guess, over the last decade or so since you've been focused on the industry, how have you seen things change? And how are things different today from when you kind of first got into it?
Well, I mean, for one, it's a lot bigger. I mean, it's just a lot bigger than it was a decade ago, 5 years ago, and it's just much more competitive as an energy source, independent of the ITC, the tax credit equity. So these just been, and I would say just generally politically speaking, just much more well accepted on a state by state basis. I think all that stuff gets very local either way. So when you're talking about entitlements, that becomes very local, right? Oregon is very pro renewable energy, but when you get very local, they're very pro land use as well. So they don't want you to put solar anywhere. It just gets very interesting. But as it generally speaking, much more well accepted, especially for smaller projects. Interconnection, generally speaking, has become much easier. I would say as a trend, I think that trend continues. There are fewer, large utilities that are making it more difficult, especially in the small project size, making it more difficult to interconnect. And historically, they've made it, purposely hard because they don't want to ruin their, little monopolies, which is nice for them. but they really have made that very difficult, and they're very very good at state lobbying. I mean, that's where they operate. They're really good. So, but anyway, so I'd say overall those trends are very positive. Again, this is on the smaller project scale. I think maybe that's a decent way to kind of segue into something, because there are very different types of solar facilities here, and obviously lots of different nuance on what solar even is and what it's doing, and how you're going to invest in it. But on the large scale size, those returns I think are going to be a lot lower, and it's probably worth kind of getting high level, what expected returns might be, because on really big stuff, 100 megawatts and above, I mean, you're likely as a sponsor, if someone was investing in an independent sponsor here, you're likely exiting those deals at a very low cost of capital, under 6% returns, very, very long term. And so then it kind of depends on, how do you want to, play in the space, whether you're going to be investing in those independent sponsors that are going to be exiting those deals and what that investment timeline looks like, or whether you're wanting to kind of sit and own some smaller transactions. And one thing I wanted to mention was on the tax equity side, especially on smaller deals, we've used tax equity, especially on the ITC side, because of the substantial depreciation. We've used that to, in some cases, as long as the investor pool or whoever your LPs are in this situation, as long as they have plenty of tax appetite, and depending on what kind of taxpayer they are, that ITC can be used in some pretty unique ways, and very much in all likelihood, it's going to dramatically increase returns, at least on a relative basis. Again, usually they're small, but they can be helpful when throwing together a fund.
Yeah, that's great. I mean, Brian and Dermot, let's get your thoughts on kind of how you've seen things change in the last decade or plus as well, but also kind of from your perspective, how do you see independent sponsors and private equity funds kind of playing the space, similar to how Michael has described it?
Within the last 10 years, the market has changed dramatically, and I really think Michael touched upon a number of the points. But I think Michael also made a really good distinction here, and we're going to focus I'm going to focus most of our discussion on those small scale projects, because I think those cater most to the folks that are on the phone today. The small scale projects are ones that are going to be more basically, you're going to have a physical PPA, you're going to have a physical offtake. You're not going to need to have a significant volatility exposure to the market. And in that regard, Michael stole a lot of our thunder here. The appetite in terms of the utilities from 10 years ago for small scale solar in particular is dramatically different than it's been today. And there's really two primary reasons for it: public push and the fear of deregulation in the market. And what I mean by that is utilities have a very strong protectionist view of their rate base. If their rate base wants to have green renewable energy, they're not going to be able, utilities as a whole are not going to be able to satisfy that demand without external development. That combined with a push for developing of small scale within the Southeast utilities in particular, you're seeing much more advantageous programs for facilities in the 3 to 5 megawatt nameplate capacity in particular, making it easier to facilitate both a PPA, which is your offtake, your revenue document, as well as interconnection for small scale projects. 10 years ago, it'd be very difficult to do that. You would need to, from a cost perspective, from a transaction and advisory perspective, it would be hard to justify a single project in that vein. Today, it's much more, it pencils out much better on a single project by project basis. From an independent sponsor perspective, from private equity fund perspective who wants to get into the space, identifying a contact, a resource, someone who has familiarity in that space, who has access to site control, that then provides the guidance for you to help facilitate the project in many ways, the way Michael outlined it, towards if not a pure ownership, but from a notice to proceed perspective, that can be sold then, that project then can be sold to another either upstream developer or to a larger infrastructure fund who has, most infrastructure funds these days have an insatiable appetite for projects. Or you hold on to those and you establish your own portfolio if you have the tax appetite that was referenced before to fund it through commercial operation and provide that tax equity. On that point, though, I'll transfer to Durham.
Yeah, no, I mean, Michael can maybe verify some of these numbers. They might not be as accurate as I'd like them to be, but
Little louder, Durham.
there's been
Sorry.
exceptional growth in solar over the last 20 years, particularly in the last 10 years. The solar industry, 20 to 15 years ago was rather, kind of a startup industry, and it has now become the primary player of new installation in the renewable energy sector. It's overtaken wind over the last probably 3 years ago, or maybe 4 years ago in new installation. And so that growth has just been tremendous, particularly over the last decade, and is projected to continue on that same trajectory. And the reason for it are items that Brian and Michael have already discussed. One of which is the electric grid is very complicated, for one, and it's got to keep moving forward. But it's also very political, and right now the political sentiment in the United States is to wean ourselves off of carbon energy. Whether that's first it was coal, now the gas-fired power plants, and it's being replaced with wind and solar. And solar right now is the predominant factor in doing that. And in order to reach some of the goals that the current administration has, that current pace of replacement of the power generation in the United States needs to accelerate, and it will continue to accelerate. Now, with that being said, renewables are intermittent and are not an end-all be-all, and so there's other that need to occur. Excuse me. And with that, it might mean, to some extent, having peaker powers and things of that nature to make it all balanced properly, with energy storage and things of that nature. But I think the main takeaway is the current solar industry has been on exponential growth, and likely for the foreseeable future is going to stay on that same trajectory, just based on the political environment and the desire by utilities and the pressure they're getting from their own rate base to integrate more renewables in their systems as well.
That's helpful. Thanks, Durham. So, maybe over to Michael. Just thinking about some of the projects that you've worked on over the years, and I know you've seen a variety of types of deals throughout the country, Missouri, North Carolina. What solar asset class are you finding the most attractive right now? Whether it be residential, commercial, etc.
Yeah, I mean, I think that really comes down to what you're wanting to accomplish with capital deployment. I mean, if there is an ESG component, I think that has some value, right? If it's pure economic, then you really need to look at the subjectively risk adjusted return for yourself, and really what that upside is. So and when I say upside, I'm not trying to say anything necessarily bad about solar, but because it's a relatively simple asset class, and very, very, very long term, we're able to pretty much project what it's going to do for the next 20 to 50 years, like relatively accurately. So that limits its upside in a way, because it's relatively predictable, which is also good, right? Decreases volatility. And so then it's really kind of where you can play and where you want to invest earlier on in that process to, basically increase those returns. So what I've seen, I can really kind of tell you what I've seen personally and what we have done. So, historically, whether it's been solar or another development area, we try to find smaller groups where we can deploy smaller amounts of capital, have those aggregate over time, right, to some decent amount of volume that we can then sell, right? There's plenty of people, I think, that fit into that category. They can be potential aggregators, whether, and really that I think that would even include small utility scale people or developers. There's RFPs that go out all the time, and there's plenty of developers that respond, and there's a new startup in in solar every fraction of a second, probably just in Texas, honestly. So there's plenty of opportunities. It's just kind of hard to sort out, who's who, who's what, what's real, right? And that's, I think, comes down to, a bit of the counterparty diligence. But again, I mean, it's a relatively simple asset class. So once you can get visibility to kind of the basic site diligence and other regulatory diligence questions, really kind of the interconnection concept that we were talking about earlier. Once you have visibility past those risk factors, it's relatively straightforward. And so I think and that's kind of the good news, is that you can kind of see, get to that relatively quickly, or see through it, I guess, relatively quickly. And so then again, we go back to identifying the right counterparties. And I think that comes down to how much, really the kind of volume and velocity you want to deploy capital. And then finding those right counterparties, picking them. But there are plenty of people I think there's plenty of people that want money to develop, but just like real estate developers, I think in general, I think a lot of them, from my own experience, I think they're dreamers, right? It doesn't mean they're not honest. It just means they're dreamers. But you have to be able to, look through that a little bit. So anyway, that's been our experience. But overall, I'd say, it's been, relatively successful, and we've been able to pick, counterparties that were pretty good at what they did. We also would typically always engage other people in that specific locality that have essentially worked with all the counterparties involved. So I use New York all the time as an example, but in New York, we were picking a developer to invest in. We would also be talking to someone that has worked with 5 other developers, worked with NYSERDA, worked with every other counterparty in that network, and said, oh yeah, these assumptions all kind of make sense, or at least close, right? And that kind of basic level of diligence, I mean, it seems like common sense, but not everyone does it. That I think has gotten, probably saved us from, 95+% of the problems that would exist. But there are plenty of deals that, on paper work that will never happen, so it's about picking those counterparties.
Yeah, so sticking on that just for a minute, can you speak a little bit more about how you kind of approach diligence with respect to like interconnection or your PPAs?
Yeah, well, I mean, I think it's probably a different question if there is an established PPA. If someone's already got one, then it's relatively simple to diligence, especially again, it's counterparty specific. So, I mean, if it's a utility, it's going to be almost really simple. I mean, I don't think there's really going to be a whole lot of issues. Not very rarely is there a new novel concept. But if it's a commercial offtake, then those can be a lot more variable. Always have unique factor in where you're interconnecting and how you're regulated. So I think I've seen a decent amount of variability in PPAs, but not a ton. So I think honestly, I'd say that for the most part, like legal has done that work. And we've touched on the business points a little bit, but so that's been on the PPA side. Interconnection, I think, is just kind of its own deal. I mean, we pretty much let engineers run that process almost completely, and so we would usually have, depending on the project flow, we would typically have in-house a couple of engineers and then multiple external third-party engineering firms running that process for us. Again, same thing there as we would want someone, like if we're working with Duke, for example, or Dominion, it's the Dominion. We work with someone that's done 100 deals, not 2 with them, because they can very much tell you, here's how long it took for the last 5. It took 6 months, or it took 2.5 years. And those are real timelines, and that subjectivity, is really helpful. That kind of feedback, because, some of that information, there might be interconnection queues out there that are very public, but sometimes it's really hard to, filter through what those interconnection queues are really telling you. So,
yeah, I think a lot of the investors in our audience, are typical private equity or independent sponsor types, and I think it can seem opaque looking at something like solar if they're not familiar with it, but then, they hear something like engineering services firms or, construction firms, that seems a little bit more, I think sometimes like a typical, independent sponsor investment and, kicks off cash flow in maybe a little more predictable way. So I think it's what's interesting to hear you talk about it and hear these guys, it's the overall trend that solar has taken over the last decade. And you can see it's not just in the projects, but also kind of ancillary services as well. Creates opportunity. Brian, can you kind of talk about maybe from a commodity perspective, what type of risks that you see and how do your clients manage some of the commodity risk that goes into the solar industry? Sure.
If we're focusing on the small scale projects and focusing on those areas where you're in a utility and you're taking a utility PPA, that again will be a physical PPA where you sell the power. The power will transfer to the project at the interconnection point, or commonly referred to as the bus bar of the facility itself, depending upon the distance of the facility's location to where the interconnecting lines are to the transmission grid. When you have a physical PPA in that manner, that's on a utility on utility paper, the commodity risk associated with that is relatively low. So long as your facility is developing, the commodity will be transferred to the delivery point and will be acquired and purchased by the utility. That is the scope of your commodity risk. It is no different than most any other supply chain. When you're looking at other projects in other parts of the country, whether it be a corporate PPA, depending upon the type of corporate PPA, or if you're selling into a market such as PJM or ERCOT, and those are generally larger scale projects, you'll have greater commodity risk. You'll have greater commodity risk because you're in more of a liquid market. And what I mean by that is that you're going to sell that power. If you're selling to a corporate PPA, you're not selling that power actually to the corporate purchaser. You're selling it into the market the corporate purchaser is providing a hedge to the underlying project. The project's going to, so for instance, a corporate PPA, McDonald's will pay for a wind farm $20, a solar farm $20 a megawatt. That power doesn't go to McDonald's. That power actually goes into the market. It's sold at a market price. McDonald's hopes it's sold for higher than $20, and if it is, then they make the upside of that hedge. If it's sold below, well, then McDonald's is out of the money on a month-over-month basis. That volatility, that related to what happened in Winter Storm Uri, that from someone who's not focused on the market can be a bit could give pause. But if you focus on the asset classes we're focusing on in this presentation in terms of small scale, utility, RFP-based programs, co-op-based programs where you're selling physically into the market, physically to a utility, where you have a bilateral counterparty, the commodity risks associated with those transactions are relatively low.
That's helpful, Brian. Durham, from your perspective, what do you see from the tax equity? How is the solar industry benefited from tax ITC, and how is Build Back Better kind of been positioned for that?
Yeah, well, before we jump into that, I just want to build on what Brian was saying about the volatility risk because so I'm jumping here. Tax equity does look like, I mean, it evaluates the project just like a lender would, and it doesn't want to take any undue risks. So, that PPA offtake or hedge or whatever you have as the revenue source is of very much interest to the tax equity investor. Now, with that being said, in most instances, their tax equity is going to be reasonable. Then they'll listen to the sponsor and to help understand, if there's something that looks questionable. But naturally, they're not going to be investing equity into something that has real downside risk to them if they're not comfortable with the overall revenue profile as well. So I just wanted to build on what Brian was saying. But yes, when we look at like what is likely going to happen with the ITC, because we live in a world right now where the solar ITC is phasing down and phasing out. In fact, projects that begin construction in 2023 will be the last ones that will qualify for the ITC at the current rate, but it will remain at 10% irrespective. But in Build Back Better, Congress had proposed kind of a revamping of these renewable tax credits holistically, kind of sticking with some of the traditional thoughts, but adding some additional layers that we don't go into details about. But in short, there was a proposed 5-year extension to the ITC for solar, as well as other technologies. Wind was getting a similar extension for the PTC, and also bringing those back up to their historic full levels for the solar ITC back up to 30%, where it's currently at 26%. And will ultimately go to 22% next year for those projects that start construction next year. The Build Back Better Act stalled in Congress, as we all know, last fall, and particularly in the winter. There is hope in the current near term that the Democrats will pull out the energy piece from Build Back Better and pass that through before they go before they break session this summer, which I think is around the July 4th holiday. So I think we're optimistic in the community right now that the Democrats, as and all of Congress, can get the energy piece from Build Back Better passed. The fear is that in doing that, certain other incentives kind of get lumped back into that bill again, and then it becomes controversial once again, which was why it kind of died last winter. But it will be very beneficial to the industry to have those incentives back, but for everyone's benefit, if those incentives aren't there, to be interesting to see Michael's take on this as well. It affects the whole industry. It's not just one developer. It's not one sponsor. It's not one project. It affects the industry as a whole, which means the cost naturally will go up. Where those have to be shared more equitably between the sponsor. You wouldn't have tax equity in deals anymore, but the off taker and the ratepayer. So the industry as a whole, still has those, I think, the benefits of high demand, but with tax credits potentially going away, which they probably won't in the near term, but there's never any guarantee to that. But if they do go away, the industry as a whole still has that high demand element to it.
Mm-hmm.
Yeah, I think the growth is at a trend that any downside effect of the ITC going away it would have on the market would be small. Now, I'm not saying it would be nominal, but it'd be small relative to the overall growth of the market. So, the ITC went away today. I think most people would agree that the solar market is going to continue to increase year over year, essentially forever in the U.S. I mean, it's a global market either way. So the global market is increasing. The ITC obviously is specific to the U.S., but the transactions they're competitive as is. Or it can be. It's just a matter of kind of returns and long-term returns. And we look at it as we are absolutely investing in solar, whether there's an ITC or not. Of course, we'd like for it to be there, and I think it provides a lot more flexibility on what you can do with the project. But I think the industry itself, if we're looking at how is it a very comfortable industry to deploy capital consistently in the long term, the answer is absolutely yes. It's going to get bigger regardless of the regulatory framework, unless we did like some gigantic U-turn, which we're not going to do, and ban solar or something. But the industry itself is naturally going to grow regardless of that incentive, I think.
From an ESG perspective, somebody mentioned that earlier, but we see continued mention of ESG in the news, and obviously a lot of corporations are focused on it right now. What do you guys see that impact on the solar industry, and how are sponsors or private equity funds approaching that? Brian, maybe if you want to start off and we go around.
Sure. ESG is impacting all aspects of solar investment and development. It's from an equity perspective, from a capital provider perspective, the pressure being provided on probably many of the folks on this phone call providing ESG funds to be able to satisfy ESG initiatives from their own investors is high. It's becoming more cognizant. Claims that used to be made from the hip 4 or 5 years ago are being much more closely scrutinized, whether it be from the SEC or the FTC or even the DOJ or state regulators. And there's a need for it because the demand from a commercial or public perspective is high. People are understanding it now. 10 years ago, environmental or green claims, people would take those at face value. Now more sophisticated eyes looking at, well, what is your ESG initiative? What does that mean? Where are those dollars going? From an off-taker perspective, whether it be a utility, whether it be a corporate or just a bilateral trade, the ESG perspectives is particularly important these days. Going back to what we talked about from the utility desire and incentive for making it easier for small-scale solar, there's a reason for that. The reason for it is that their regulators are asking for it and their stockholders are asking for it. It's very simple, and that's not going to go away in the current climate and environment. And then from an overall development perspective, from a federal regulatory framework perspective, hopping on what Michael was saying, the likelihood there's a U-turn in regulations that would be in any way would hinder or damper renewable claims or the solar development as a whole, you can never say zero, but extremely limited, given the desire and the sentiment in the market right now, and the push, at least from the current administration, for greater access to renewables. So from a claim perspective, from an off-taker, from an investor and a capital deployment perspective, where more of those dollars are being directed towards greener funds, and then from a regulatory framework, ESG is having an impact on all aspects of it. And we're just focusing on the environmental side. There's a social justice component to ESG too that I think is going to be more refined over time in terms of local content and requirements that might be, and maybe it's something that Durham can touch upon. With Build Back Better, there's going to be a heightened, and keep me honest here, Durham, there could be an additional opportunity for additional tax equity leverage, given if there's certain local content in terms of local hiring of local contact, women-owned businesses, minority-owned businesses, and development of certain types of renewable generation. So all aspects of ESG will have a significant component in the continued force of solar and renewable development.
Well, yeah, just to build quickly on what Brian said, the Build Back Better, the energy piece, it highlighted, it will make things a bit more complicated. And there are specific benefits for minority-owned developers or projects owned by minorities, permanent minority-owned businesses. But also, there's domestic content requirements. It's kind of in lieu of, in the same vein of ESG. So there can be U.S. domestic content requirements that give you special incentives, such as a refundable credit, so to bring tax equity in. There's also like prevailing wage elements and things like that. It just kind of goes down the ESG theme. I personally, I've been doing in the renewable energy industry my entire career, and so ESG is relatively new. So I feel like I've been in it for a while. But one of the things that highlights ESG to me is I live in Houston. I work in Houston, and my neighbors are all in oil and gas. And so just a couple of weeks ago at spring break, one of our neighbors was kind of moaning and groaning because he's as an upfield. He's in the upfield upstream oil, and they have wells and everything production. And his equity investors required that they procure a certain amount of RECs to offset their electrical consumption. And so he was all up in arms about paying for that. But it just highlights how ESG is hitting the oil industries as well, and it's something that this community that's on on these calls is solving for them.
Yeah.
And this is anecdotal just because I live in Dallas. I honestly didn't say I worked in renewables 8 years ago, solely because in Texas, you didn't know whether that was a bad word. Like sometimes it really was, like people would get upset. It's not, I'm not saying it's completely changed. Texas is still Texas, but it really has dramatically changed. And certainly at least outside of Houston, it has dramatically. And so, it's very much embraced. And so I always give the example because a lot of the people we work with started in California, right? A lot of these developers got a lot of experience developing in California, and just a lot of people I used to work with. And so I always use the example of, if it worked in California, great, plenty of incentives there. It can also work in Texas, and it can work anywhere, right? And so you've seen Texas and Florida completely embrace renewables, completely embrace solar. So it can work basically literally everywhere. And so there really is just a ton of room for growth, in the market in general. So.
Well, that's great. I really appreciate everybody's time here and joining the panel. We're going to test out the Zoom to see if this works for questions. So if you have a question, go ahead and see if you can unmute yourself and fire away, or you can shoot me a chat in the chat box.
I have a question. Thomas Thanasis here with Caprock from Austin, Texas, utility scale developer in Texas and other states. Question has to do with today's decision announced by Department of Commerce on the anti-circumvention case. How do you see that going and the impact on the industry?
Yeah, hi Thanasis, this is Durham McCormick. Good to hear your voice. I'm aware of the case. Unfortunately, I haven't looked at. You're talking about the tariffs, is that right?
Yes, the case is filed by a small vendor, and it's about Chinese manufacturing panels in countries other than China, and therefore circumventing all the tariffs that had to do with China. And so the case is that whoever sells directly from China and then just assemblies panels in countries like in Southeast Asia, like Vietnam, Cambodia, etc., they should be subject to those tariffs.
Yeah, and it's up to 250% as a factor. Yeah, we're looking at that. I mean, unfortunately, I can't tell you. I mean, I just don't know firsthand how it's gonna. I mean, the impact could be broad and wide. Hopefully, it's not. I mean, we're seeing panel suppliers already issuing kind of shifting risk to the purchaser for those tariffs. I mean, it's like one solution that we're already starting to see, and this is only 24 hours into it. Other suppliers I've heard, once again, 24 hours into it, are just refusing to supply into the United States. I mean, Michael, you're probably dealing with phone calls right now as we speak on this issue.
Well, I mean, we look at procurement so far in advance. So, I mean, not to say that this obviously isn't a change, because it obviously is. It's, again, as you kind of noted, solar is very much a global market. The U.S. is a piece of that, but we are not the biggest player. And I don't know. I really don't. I would say a lot of smart people, plenty of smart people on this call. Usually we find a reasonable, I want to say workaround. Maybe it's not the right word, but that's what ended up happening before. But we usually find something that works, right? That doesn't make it some dramatic material change that would, affect every deal, I guess is what I'm saying, in a material way. Yes, I think there are probably some fringe deals that probably were difficult to make work anyway. That might get a little bit more complicated, but likely that kind of sorts itself out over time either way. Hopefully costs are coming down either way over time. And so it'd be a matter of really delaying a project versus wholesale material failure, right? I mean, that's generally what I see. That's what has happened with kind of each shock we've had over the last 5 to 6 years. And so I would say that's likely the same thing here. That, again, it doesn't really answer the question because I don't know what the result will be. I think there'll be a lot of different results that get to something that works for the deal and basically like when it needs to close. I think it's probably really hard to close a deal right now if you haven't procured panels. But there'll probably be quite a few different options, in the next few months as we look at things.
I think this is going to be an acute issue for projects that are, I think, as Michael framed out, that haven't locked down module supply and that their modules aren't actually in the U.S. as of yet. This has not been a surprising issue that's been out there. This result is a bit surprising, but the issue regarding Chinese content has something that's been out there for quite some time. You have had a number of suppliers, as the NASA's pointed out, just assemble Chinese parts in jurisdictions outside of China. At recent conferences, a number of those suppliers made it very clear that they're moving more away from Chinese content at all and using those Malaysian and Vietnamese plants to use actual content that's actually developed in those countries or in other countries outside of China. Now, for folks that are aware of it, the polysilicate is a commodity that is more likely not sourced from China. That's going to be very hard to move away from. So that's an issue that still remains to be seen. But what does this do? This is just another issue that's going to be addressed in acute. In the short term, it's going to be an acute issue. It's going to be something that's going to definitely have an impact on projects that are in process right now. Long term, you're going to see this be something that supply chain is going to have to adjust to. There'll need to be better record keeping. There'll need to be better diligence. I think as Durham highlighted, this will probably be a shift, a risk that's probably going to be shift away from the manufacturer of panels to a developer. And if it's going to the developer, it'll be going to the end user by way of covenants and a PPA in terms of shifting that risk downstream for any costs and the tariffs associated with identification of Chinese content.
Any other questions? And thanks for the question, Thanasis. All right, well, thank you very much to our panel, Michael Gardner and Durham McCormick, Brian Kelly. Really appreciate everybody's time this afternoon, and hope everybody has a great rest of your day.